Hello, everyone. Welcome to Cruising Altitude's first official Zoom video recording type of vibe, or our fourth podcast. And this is very exciting for all of us. Today, we have special guests, Ryan Henderson and Brett Schaefer from the Chit Chat Money podcast. I'm joined by Ryan Money from Cruising Altitude. And for those that do not know, Cruising Altitude is a investment publication, newsletter, media company looking to educate the next generation of long-term investors. As you guys can hear, we have two Ryans with us today. So we're going to be calling Ryan Money from Cruising Altitude, Mr. Money. Brett and Ryan Henderson, welcome to the show. It's awesome to have you guys.
Thanks. Yeah.
Glad to be here.
I like what you guys are doing. Keep it up.
Thank you. So before we jump into it, the main focus of today's recording will be on Sprouts Farmers Market. Our goal here today is making grocery stores sound as exciting as cloud computing and genetics, and try to get people excited about this investment opportunity. And I honestly don't think it is too hard to do that. But before we jump in, Ryan and Brett, I want to ask you guys if you could share a little bit about the fund. You recently started a fund called Arch Capital, and Sprout Farmers Market is one of your bigger holdings. So if one of you guys want to jump in and kind of share the story with Arch Capital and your philosophy.
Yeah, Ryan, you want to start, and then
I can go.
And then I'll pick it up. Yeah,
it's the story behind it. We've wanted to do it for a long time. We had it kind of in the works since, the summer, but even I would say 2 years back, we kind of started investing together, just Brett and I. It wasn't really the same account, but we would go through our theses together and kind of basically had the same portfolio. And we finally just decided to do it officially and do it right. And so we merged this fund that's called Arch. I guess the technical name is Arch Capital Investors Fund. It's really mostly just family and friends right now that are invested along with us ourselves. And it's a concentrated set of high quality businesses. We've tried not to overcomplicate it. We don't try to run some arbitrage strategy. We can use options if we want to, but we don't really. We stick to just long-term holding of good businesses, and we're going to hold them as long as they operate in the shareholders' best interest, and as long as we see reasonable upside to the businesses we own, we'll keep holding them. Brett,
yeah, and then I mean, we're young guys. We know that we're not, I don't know, someone with 10 or even 20 years of experience. So we're really starting this out small, and it's really just a way to do well for the clients that have signed on, which is basically one, our family, and a few friends, and hopefully to grow that over time. But it's really to, do well for them, establish a track record. This long only, we hold about 8 to 15 companies. We hope to have low portfolio turnover. It's very boring, and it's not like a unique strategy at all. So I don't know how it's going to sell if we ever get to one of those big rooms, but we hope to just, have a patient strategy and do well over the long term. That's the goal.
Awesome. Mr. Money, before I hand it over to you, I just wanted to point something out that Ryan and Brett mentioned. You guys were talking about how you guys aren't doing something totally novel or totally out there with the algorithms and Excel spreadsheets and all of that. Investing does not have to be that complicated. I think in today's world that there is a lot of pressure for it to be that way. But if you're able to kind of keep it boring and just put your money in good companies, you're probably doing something right.
Yeah, totally agree with that. That isn't to say we still in our minds, I think all investors are doing it, but we're just extrapolating earnings out and kind of discounting it back to the price. Whether you do that with some perfect algorithm, I mean, there's always bias involved. So we try to eliminate as much of it as we can. But yeah, to your point, it might be boring, but sometimes those boring companies can have really good returns. So that's kind of what we've found.
That's Sprouts Farmers Market. Yeah.
Exactly. And that kind of takes us in to the discussion today about Sprouts. For our listeners, in case you didn't know, because, coming in, I wasn't the most familiar with Sprouts as a store. I'd heard of it, being traded on the markets and everything. But if you didn't know, Sprouts is a chain of grocery stores. I think it has around 360 stores across the country. It's primarily concentrated in California and a small concentration in Texas, with several distribution centers around Arizona, one in Georgia, and then I think one in California. And they cater to a healthy consumer, one who is very conscious of their health choices, and they sell mostly produce, which is something different that a lot of grocery stores kind of sell more consumer packaged goods or CPGs, whereas Sprouts has more of a food focus. So yeah, today the goal is to make Sprouts as exciting as some of the other companies that we're talking about, and just trying to spice it up a little bit. So to the Chit Chat Money guys, what in your minds is the value add? What's special about Sprouts, and why is it 10% of your holdings?
Do you want me to go first, or?
Yeah, go ahead.
Okay, I'd say there's not, what's special about Sprouts is kind of a tough question. I would say it's different than a lot of grocery stores out there. When you look at them at first, you think that they're competing with Kroger, Walmart, what are the big ones? Publix, whatever, all the ones from across the country. Basically, everyone's owned by Kroger. They just have different names, but they're really competing with more of Whole Foods and Trader Joe's. But they're trying to be like Whole Foods, but with, half the price kind of, Whole Foods is extremely expensive, but Sprouts is not going for the high margin stuff. They're really trying to compete on price. So I think that makes it unique. So they're not necessarily competing with someone like Kroger, but I don't know. Is there anything else special about them, Ryan? I think I like the business, but it's pretty standard.
I guess if you're not familiar with a Sprouts store, because I think it's 362 stores across the country, and they're not really in the Northeast. I mean, I think they're only in like 23 states, but when you walk in, it's a really low layout. So there's not big, tall aisles like you'd see in like a Safeway or Fred Meyer, or I don't know what the stores are over on the East Coast that are really popular. But they have everything so that you can see basically across the whole store. So it kind of speeds up your time where you're in the store. And that way they're able to kind of reduce the occupancy, which in turn allows them to reduce the square footage needed to house everyone or to have all the shoppers in the place. So they're really that's why they're reducing that store model. I think their average square footage right now on a building is 29,000.
Yep.
I think Walmart or Target are above 100,000. So it is very small to get people in and out faster, but the revenue per square foot is like 6 times higher than Walmart. So that's kind of the differentiator there. So that it's a little bit of a more profitable model that way. That's kind of the basics of the business, and they are growing. They are profitable, which I think we kind of already hit on that. New management came in, I think, in 2018. Jack Sinclair, he was head of grocery at Walmart prior to that, so he's familiar with scaled businesses. And I think he actually was the CEO of a different company in the grocery space as well, but he's just like an avid food person. It's strange.
Loves grocery foods.
Yeah, he's got decades of experience, and he was actually VP of US grocery for Walmart. So that is the top guy in the United States. So we really like management and what he's doing, and he's turned them around to positive comp sales. They have in 2020 got a boost from the pandemic, obviously, for comp sales, but even before that, they're doing well. And then to go back to the outline before we maybe move on, they have the map of the outline of the store on the website, so it is a little unique. They do have bulk sections as well. So that's kind of another differentiator where that's open. And then they have the produce, and then they have a few aisles of the standard, frozen stuff. But it is, put for people like, whatever, that are following a paleo diet or gluten-free or vegan or whatever. And then they also have vitamins and supplements they're big on that as well. So that's all encompassing the, the health enthusiast, which it's not like 100% of the population, like maybe Costco or, Kroger, but it's maybe, 5 to 10% of the United States population that they're targeting.
And I think if I could jump in and share a little bit more about the concrete fundamentals, I think you guys hit on a lot of the qualitative points that make it very exciting and a unique value proposition. But in 2017, they did 4.6 billion in revenue, and now in 2020, they just announced they did 6.5 billion in revenue, with about revenue growth of 10% a year. And every one of those years, they did over 150 million in net income. In this past year, 287 million in net income. So they are a cash generating machine. And one thing that also is awesome about it is it's a real business, like Ryan Henderson was saying. Forgot about the Mr. Money Ryan. Like Ryan was saying, that there aren't many companies these days that are businesses that are profitable, and there's something very refreshing about it. And yeah, Mr. Money, you want to talk a little bit about their share buyback program and how that can also be a great asset to current investors in the company?
Yeah, and just to speak a little bit to the point, I mean, the way I think about it and the small size of the stores themselves, it's kind of like a fast food restaurant, right? The idea is consumer walks in, we want you out as fast as possible, and we want to replace you with more bodies. And the bigger your basket is, and that's what they call it in the field, they call it your basket size. That basket size is lower on a per customer basis. I think it's in the low 40s. And we'll get into all this later, but their e-commerce and everything, those basket sizes are a lot higher. And so I kind of think of it with that fast food model. But to talk a little bit about the share repurchases, in 2018, they bought back 11.1 billion in their shares. 2019, that number was down to 7.9 billion. But, and I mean, I think we can all agree that it adds a lot of value to the share price and to the shareholders. You're going to see the price go up as a result. And Alan, I know that you mentioned that they planned one for 2021. I didn't read about that. So if you
I can speak on that.
Yeah.
And I think you meant, I do like share buybacks a lot, so I get excited when a company announces them and they can do it sustainably. But I think you said billions there, but I think you meant millions, because the market cap is only $2.85 billion. So just to make that clear, but the market cap is about $2.85 billion, and they announced a $300 million share repurchase plan over the next, I believe it might have been an indefinite time period, but I think it was over the next 2 years. Either way, they have a history of buying back their stock, and that, sometimes when a company buys or announces a buyback, you get worried. Like, for example, a company we own, Dropbox, they have a history of buying back stock or announcing share repurchase plans, but they're not really reducing the share count. Sprouts, on the other hand, has a history of reducing the share count. And yeah, I mean, if you look at it versus the market cap now, the stock could go up whatever 10, 20% or something like that, and they wouldn't be able to reduce the share count as much with that $300 million. But we think, and part of our thesis is that, conservatively, they're going to be able to reduce the share count by about 2 to 4%, or maybe higher, if things go well over the next few years. And that's just going to be beneficial to shareholders if they can execute on their business plan.
Yeah, and I'll add to that. So I think over the last 5 years, I want to say they've reduced share count by 21%. So
yeah,
if you're listening, you don't understand the relevance of that, their earnings over that time frame, I think, is up like 130%. So maybe a little more than doubling. But earnings on a per share basis, so what the shareholder is getting, has almost tripled. So that's sort of how valuable those share buybacks can be. And then, as Brett just mentioned, they announced another 300 million. And the other thing is, it's one thing if you're buying back shares, but then you're just issuing stock options to your employees at will. So then it's really not that useful, and it's not a very good it's not very good capital allocation on the management's part, but that's not happening here. I'm not sure that's really the nature of a grocery business to begin with, unlike some of the tech names that we also own. But yeah, it's been useful buybacks, I guess is the way to put it.
Mhm.
So for an investor that's thinking about this opportunity, the stock, I think, was IPO mid high 30s, right under 40, and all it's done is gone down. It's at $24, and I don't know where it closed at, 12 cents today. Why should I invest in something that isn't moving? Of course, the share buybacks, but why do you guys have confidence that the stock will move one day?
Well, yeah, so that's probably the biggest thing that people say when they look at Sprouts. They're like, oh, it hasn't gone anywhere for years. But if you look at the underlying fundamentals, yeah, in like 2017, 2018, comp sales were kind of struggling, but the business overall has improved year by year. It's just that it came out at a valuation that was not really reasonable. It must have been like 40 to 50 times earnings. And now we're down. So, I mentioned that their market cap's at about $2.85 billion. Last year, they generated almost $400 million in free cash flow. COVID had a bit of a boost for them, but their opening share are 22 stores this year. They think they can open stores at a rate of about 10% per year. And with only 360 stores and no market saturation, except maybe you could argue Arizona. So they have a lot of different markets to go to, including the Pacific Northwest, Florida, the Mid-Atlantic, the Northeast, and even more in Colorado and the Rocky Mountain area. It's trading at a reasonable valuation. They're buying back shares. They're profitable every year, and they have a high predictability to grow their top line at about 10 to 12%, and even higher if they can get back to strong single digit comp sales. Did I miss anything there, Ryan?
I love when people point out well, the stock hasn't gone anywhere. It's like it doesn't. If you're getting on an elevator, you don't care where it's been. You care where it's going. We don't really care what's happened to the stock recently. We care what's going to happen to it. And if we're sitting there with a earnings multiple, I think at like 10 and a free cash flow multiple at 7.5 times. I think Target and Walmart have multiples above 20. And you've got a more profitable model with the path for expansion is so clear. I hate to call it a growth business, but the business is growing. The underlying business is doing really, really well. So we don't really focus on what the price has done previously. We just focus on the business, and hopefully the security isn't overpriced.
Yeah, it could go down to 3 times earnings, but that seems unlikely. And we honestly think if they succeed, there will be room for multiple expansion. I know, we're fans of that book, 100 Beggars by Chris Mayer. And the biggest takeaway from that is you have to have multiple expansion and underlying growth for a stock to be a home run.
And a small cap.
And a small cap, which these hit all 3 criteria. We're not saying this is a 100 bagger at all. We just think it's a good opportunity.
For sure. And I think that that one of the coolest things about the company is that they aren't that well known. A lot of times when people talk about, oh, they're not well known, that's a bad thing. No, that's a great thing. When you are sitting here, I'm doing already $6 billion in revenue, very profitable, nice cash flow, share buybacks, and that you aren't that well known, that's a huge asset. And their database of customer knowledge is a lot deeper than people think. They have 3 million emails. That's a lot of emails of individuals nationwide. They have 273,000 Instagram followers. That's a huge Instagram following. And the fact that they only have 300 stores, I think that's a huge asset to the company.
Oh yeah, because compared to someone like Kroger, I mean, the growth is just, there's a clear path to growth. And we love a business where it feels highly predictable. Now, again, 2021, it might be different just because of the weird COVID dynamics, but we think with the store openings, there's no reason they can't. Yeah, they're competing with Trader Joe's a bit, but I don't know. I mean, there are some concerns, but
yeah, I want wouldn't extrapolate the trailing 12-month comp store sales growth out into the future. I mean, sales might honestly be flat over the next year, but over the long term, when it's normalized, hopefully it's growing in the mid-single digits. There was no one going to restaurants this year, so everyone just bought groceries, which boosted Sprouts Farmers Markets, sort of artificially boosted their performance for this year.
Yeah.
Mr. Money, do you want to touch a little bit on the Mr. Money? What's nice about him, I'm a little bit more of a passionate guy that does the in-depth research, but kind of looks at a vision. And I get excited about a vision. And I see this as a $2 billion company that can be a $20 billion company. But what I do is I send Mr. Money deep into the weeds to look at accounting and not so fun things like that. Mr. Money, what cool things did you find when you did that?
So I did pick up one thing that I thought kind of really differentiated Sprouts from a lot of the other players in the market. I know when I was kind of looking at comparable companies, we looked at Go a lot, which is Grocery Holdings Corporation, just trades under Go. But one thing I picked up in the Sprouts 10K is that their sales mix is really interesting. Kind of how I mentioned that Sprouts sells a lot of produce. That is a very important distinction that it needs to be drawn from a lot of comparable companies. Whereas, so just to start off, Sprouts is perishable to non-perishable sales mix. Almost 60% of their in-store stock consists of perishable food items. Those are items who are like fruits, vegetables, meat, things like that, dairy. All of those prices are kind of fluctuating all at the same time. Every grocer is having to pay those as time goes on at the market rate. So in a situation like COVID where those prices are increasing and that basket is increasing, the CPI, and then you think about non-perishables being 40%. For a competitor, that distinction, their perishable food items are kind of turned on their head. So they're about 30% of the sales mix. And what's really interesting about that is an account. No, I sound like a nerd for this, but when you think about FIFO inventory accounting, and you think about how that applies to perishable food items, right? Those are items that only really stay in stock for a week or two at most. Those prices are kind of not really dependent on FIFO method because you're constantly having to replace that inventory. And then you think about this lower percentage of non-perishable food items that have this, when you talk about FIFO, the older inventory is what's put into COGS. So if you have a time frame with rising prices, non-perishable items are going to have a lower per cost and are going to inflate the net income. And basically what I'm saying for Sprouts is that this is mitigated because most of their inventory is produce and other perishable food items. So I thought that was really cool to think about.
Yeah, that's interesting. I think another thing to think about with produce, so with there being a higher mix, I know they mentioned 68% of their food is attribute based, is how they describe it. So that's either the produce they include into that, or dietary based or whatever, all the special stuff, oat milk, stuff like that. The key with that is getting their new distribution centers within 250 miles of every store. So one problem they've had is in like somewhere like Colorado, they don't have a distribution center really close by. That one, it hurts their margins because they got to ship stuff over the mountains, and other bigger chains will have an advantage there. But two, since everything is fresh based and they try to get partnerships with local farmers, stuff like that in places where they really have the market going, that gives them an advantage where the customers are going to be more satisfied because the produce, their bread and butter, is going to be fresher.
Yeah, and aren't they getting a distribution center in Colorado this year?
Yeah.
Didn't they say they were planning that out?
Yeah.
Right.
I should have mentioned that too.
Because I think they have 5 right now, and they're planning to have 7 by the end of 2021. So.
Yeah, and that's what you would think, like, okay, we have 4 out here in the Pacific Northwest where we are. We have 4 stores. And you would think, all right, there's a lot of room. Seattle's like a easy market for them to enter, right? Trader Joe's is a hit out here, stuff like that. But they don't have the distribution center ready for this place. So they're probably not going to add that many while, but they're adding the distribution center in Florida. Now they're going to target that market and open, I think, I don't know, 10 to 15 stores in that region this year. So they really want to focus on getting stores in places where they're close to this distribution center, because customer experience hasn't been that great. So they really, they're going to be all problems with that. And they've talked about, there's been suppliers that have had issues with stuff like that. But yeah, that's kind of important with the whole produce thing.
It gets me a little eager when we think that when we realize that they haven't really tapped into the Northwest market, because it's such an easy transition. Like if this started in the Northwest, I'd be a little more skeptical of how it would transcend across the states. But it seems like such a logical next step for management to just scale into the Northwest.
Yeah, and the Northeast too.
Yeah.
And you guys are talking from experience, correct? Aren't you Northwesterners?
Yeah.
Yeah.
That's why we say they're like 4 up here and people love them. So
it's not like you guys are from Cleveland, Ohio, like me. You guys are talking from experience. That you guys know your people. I think one random thing that just came to my mind that's really cool is Trader Joe's is known for their privately labeled foods, right? Which is great for the business of Trader Joe's. And actually, Sprouts Farmers Market introduced 5,100 new privately labeled foods, which they said led to an increase in 35% in sales. I think that was responsible for 35% of sales, something like that. But
that makes sense.
Privately labeled foods is good because it's, I think, about 20 to 30% more profitable. I talked to an industry expert on that, aka my sister, but that's what she does. But what is really cool about Sprouts is they have normal foods, right? The cereals, you can get Captain Crunch at a Sprouts Farmers Market. You cannot get that at Trader Joe's. And I just think that's something that's really cool within the value proposition of Sprouts.
Yeah, I know that when I go to like Trader Joe's, we have one, we live in the same city and Trader Joe's is right by us, so we go there. The supply is a lot more limited than a Sprouts. Now it has that unique concept that everyone loves, and they have a great operation, outside of like the food even. But Sprouts does have that variety where you go there. Like I go to Trader Joe's sometimes and there might not be something there I like, or they might not have something I want. But at Sprouts, it's more standard, which people argue, on the flip side, okay, does that make it a commodity? Is it any different than whatever, Fred Meyer, any of the standard, Publix, whatever? But it has, I think it's just a good mix in between. And even if it's a commodity, they have a proven model where if they keep the same margins, if comp sales are even not that great and they can open 10 stores a year, I mean, with the stock where it's at, I think there's a lot of margin of safety there.
Yeah, and it might not be a full Trader Joe. Trader Joe's is like very niche. It's all over, but the shopper demographic is kind of niche. It's basically the opposite of your typical grocery store like a Walmart or a Target, whereas Sprouts Farmers Market is kind of, I think it is in sort of a perfect middle ground where people that are trying to make that sort of jump to the other grocery stores, Sprouts is kind of the ideal spot to go.
Mm-hmm. And so talking about that, can y'all speak a little bit to the new store model? I know they announced plans to open up a new kind of store that's going to save 20% in square footage, and it's going to be 20% cheaper to operate.
Ryan, you kind of about that. Do you want to?
Yeah, the idea. Well, so from what they've said is the average ticket doesn't drop when the square footage drops. So the customers are still spending enough. If that is true, and you can get cheaper operating leases, for reference, right now I think it's the typical store is between $28,000 and $30,000 for Sprouts Farmers Market. They're planning to reduce it to between $21,000 and $25,000. So if they can do that and they can get cheaper operating lease costs and still drive the same amount of sales, you know, you don't have to be a genius to know that's a little bit of a more profitable business model. But right now that I don't think is coming to fruition until 2022 when
they're testing it. They're testing it right now. I think they have like 2 or 3 concepts this year,
and they've changed some store models, I believe, to the newer one or to the newer format. So
yeah.
I guess we'll see in these coming years if sales don't drop, because if that's true, that's a great sign.
Yeah, and another small thing is that they've had complaints in the past about checkout. It's not great. They just have the standard 8 slots, or a little maybe smaller. They don't have self-check. They don't have any of the small little innovations that someone like Trader Joe's has done, where it just makes that process a lot quicker. So that's a real easy fix. And management did mention they're going to get that up to, you know, modern levels. But another part about, I think, how investors should think about the store is, I hope I'm getting these numbers right, but it costs about, I think the old stores cost about $4 million to complete. The new ones will cost about $3.2 million to complete. If you look at their store count versus the free cash flow or operating cash flow they're generating, each store on average will generate about $1 million in, say, conservatively just operating cash flow, because I guess the capital is already invested. $1 million in operating cash flow each year. So they'll get a return on that investment in 4 years with the old concept. But now if they're investing and they get the same returns, you know, in dollar amounts on 3.2 million, and you can get $1 million in operating cash flow each year on average, we think that, I mean, there's nothing wrong with that.
Yeah. And those numbers aren't even including potential comp store sales growth, really. Right.
Yeah.
And the more that you have that private label mix, I guess that could bring in an element of pricing power a little bit if people are really tied to that specific private label stuff, which could help drive comp store sales as well.
Yeah, and we'll let you. Yeah, one more last thing on this that I would mention. This is more long term too. Is places where they're more saturated and they have contracts with local farmers and things like that to get things that aren't just, I don't know, like produce and stuff that isn't just the commodity stuff that's going around to the entire country. They want to, you know, through the email newsletters they have and stuff like that, make it more like Trader Joe's. So kind of, you know, slowly become more like that, where you have those unique products that people go to Sprouts for, and it's just locally based. So it's like, all right, we got local butternut squash or whatever. And that can be a way for them to build a moat over time. It's still a bit of a commodity product right now, but the investments they're making, what they're talking about, they mentioned that they can do that over the long run.
I think when I asked this, I'm kidding. I think so. But does the CEO, Jack Sinclair, sounding like Conor McGregor, influence your thesis in the company?
I listened to his TED Talk. He did a TED Talk on fresh food, which should show you how much he cares about fresh food. He does have a nice little Irish accent, and we're recording this on St. Patrick's Day. Is it Scottish?
Yeah, it's Scottish, I think. I think he's from Scotland.
So no, I like Jack Sinclair though. Yeah, I mean, I wouldn't say his accent has a whole lot of influence on our thesis, but
yeah, I mean, I don't know. We always joke if someone has a British or United Kingdom accent, we always think they're smarter. But to be honest, management is important to the thesis here, because before they saw comp store sales either flat or declining a bit, which is really troublesome for a grocer or any sort of retail concept in general. But Sinclair came in. I mean, again, his track record's strong. Walmart really turned things around on the fresh. You know, if you go to some Walmarts might not be that great, but their produce and their, you know, it's a lot better than it used to be. And he also poached a lot of his team members. I don't know if they were exactly like under him or anything like that, but he has, I think, 2 or 3 people that are from there. So he's building out a team with all new guys and women too. I don't know. I just think there's a lot to like with management team. It's not like anything quantitative, but when you read the transcripts, you listen to them, they understand what they're doing in the grocery business.
And I also, I like passionate CEOs, like people that really, really care about their business, but I don't like promotional CEOs. And I think Jack Sinclair really fits that mold. You know, he's not on Twitter pumping his stock or anything like that. So, yeah, he fits kind of what we look for.
Yeah.
He hasn't tweeted Sprouts price is too high, in my opinion.
No, he is not, and we are very happy for it. And to be honest, they probably want the stock price low for the time being. I mean, we, you know, if they do well, it's probably there will be some multiple expansion. We would think to back to, you know, either the market multiple or whatever the traditional grocers stay at about 20 times earnings. But with the buyback in the short run, it's ideal for the stock to stay where it is right now because they can really reduce the share count. And with a lot of the debt gone, I think they have only $260 million in debt left, generating, you know, that's less than 1 year of free cash flow. They can really reduce the share count if things stay similar.
Absolutely. So, and then to kind of follow up on that, great bullish thesis, what is one thing that y'all are maybe wary of or potentially poses a red flag for you guys?
Yeah, I mean, it took me a long time to kind of figure. We want to try to find flaws because obviously we're not the only one looking at the stock. So why is it trading at that multiple? There's probably some sort of flaw in the business. But the industry is super fragmented, and grocery historically hasn't been a great place to keep your money. So there's so much consolidation in the space, but I don't know. I'm kind of reaching for a macro problem there. Like if you just look at the business, it seems like it's humming along. Like those are just potential headwinds that could happen, but I would say I'm still reaching there.
Yeah, I would go with the big one that people talk about is Amazon, and through Amazon would be Whole Foods. Amazon's making a lot of investments in grocery through Whole Foods and the other stuff. People get scared about that, but I would just ask yourself, they've owned Whole Foods since 2017. Sprouts has grown its business each year, all parts from the top line to earnings to cash flow. They could change. I don't know. They could really do some things and change it. Walmart could really do some things, but to be honest, they're not competing with them. They're competing with someone like Trader Joe's, niche products that are going after these health enthusiasts. The competition, I think, is a lot less than people ascribe to. And it's really all on the business execution. And grocery is tough. But the thing is I don't know. The grocery is tough, and that's the hardest part about it. But the margin of safety is there where if they're unable to expand well, if they're unable to grow comp sales at any sort of sustainable rate, if the concept doesn't work and say, I don't know, they go to Chicago, concept doesn't work, they're fine. They're not levered up a ton. They're actually reducing their leverage. They might not execute and it might be a market underperform, but I struggle to see where, and this is where you get into trouble. I struggle to see where over the long term you lose money unless the multiple compresses even further.
And the Amazon stuff is so, like, what advantage does Whole Foods have that Amazon acquires them? Are they going to reduce? Are they going to run it like a loss leader? Are they going to reduce prices by half in order to compete with Sprouts? Probably not. And you could say they've got the tech for like ultimate shopping convenience, but I think we've talked about this before. That seems like a solution looking for a problem. Like, I don't think people are really that. I don't think people like the grocery delivery as much as people might think. You know, like, I like going to the store still. I didn't like the grocery pickup. I don't want someone to get my noodles wrong or whatever. So I don't see Amazon as that big of a threat. Although, you know what, if they announce some new Whole Foods deal and Sprouts stock drops because of it, I guess that's a great opportunity.
And I don't know about you guys, but when I was thinking about Sprouts, I'm thinking this past year has been rough. Everyone in the country has been locked away in their houses all year. The only solace that we've had over the past year has been going to the grocery store. So, you talk about sales flatlining, but maybe for some people it inspires this love of going to the grocery store. And I guess making people more grateful to actually have to go in and purchase your fresh produce from someone who you know is local, in Sprout's case, 250 miles away. So I think it's also something to think about. The affinity that people have with their brand is important. And I think that Sprouts in some ways probably inspires an affinity that people don't have towards Whole Foods necessarily.
Yeah, I'd agree.
Whole Foods, they're in a little bit of a conundrum with Amazon, because Amazon was known for low price, but Whole Foods was the exact opposite. So they're in a little, they're kind of in between a rock and a hard place there, where Sprouts is honestly, I kind of think about it as they want 90% of Whole Foods for 50% of the price, none of the fluff. That seems like something that Amazon should have bought instead, to be honest.
And I think one thing to hammer home that Mr. Money just mentioned is people, not only have we been trapped inside and grocery stores been the only solace, but we've seen the giants get even bigger. Scott Galloway, I know, talks a lot about how Amazon, Apple, all the big tech companies got so much bigger. And there is an increasing desire to how can we give back to our local communities. And part of the Sprouts thesis is that it does just that. And what's very cool is they continue to scale. They look to incorporate that into every new distribution center and new location they go to. One thing that I wanted to mention, and I was saying, I'm a dreamer. I think big. I look at this and think that this can be, and of course, this is not professional investment advice. Don't worry, Ryan and Brett will handle all that in our intro video. But I see this can be a 10-bagger. Why grocery stores? Who knows? I think there is significant value to building a brand. And even now, when I look at GameStop, if I'm GameStop CEO, I'm saying, how can we turn into an apparel company? How can we figure out a way from being a brand of the people to making that into profitability? And I was saying that they already have 273,000 Instagram followers. That's a lot for a company that isn't that big. And what do you guys think about that possibility of, once you have 1 million, 2 million Instagram followers, the ability for either digital ad revenue, I'm sure they're very wary of that, but other ways to monetize their brand?
That's not something that's come up. I do like how they have, the emails. They have all the emails that they send the newsletters to. As just an investor, I get the thing to kind of see how those are. It's kind of like those ones they send through. The Instagram following is great. I don't know. I'm having trouble finding any ways that they could, or any kind of thoughts now of how they could do that. But I don't know. Ryan, you have any?
I would say instead of, I don't think it's going to provide a whole lot of optionality in terms of where the revenue comes from, but I do think it'll serve as a valuable marketing funnel.
Yeah, I guess, yeah.
It's not very expensive to post a picture on Instagram. So especially if you can really grow that audience, although I see so many businesses now like brag about their Instagram followers. Like, I don't think it's that big of a deal. Like, I never see an Instagram post and then I'm like, I got to go to the grocery store now.
It might matter if you could sell groceries through that. And it might matter for someone doing like women's clothing.
Discount awareness.
Discount awareness. Yeah, stuff like that, or specials, stuff like that. But yeah, and with like that Instacart stuff, so they have the partnership with Instacart for e-commerce and delivery and pickup, or not pickup, they do themselves. But again, that just seems like maybe it's just my personal perception, but Ryan and I have talked about this, how that's a flawed concept. That's another thing that people talk about, the risk where it moves to this, food delivery, DoorDash, Amazon, Instacart. But it's just, I don't know, you got to just think outside of like being a tech bro from Silicon Valley. Most people would rather go to the store. I like going to pick out produce and stuff. It's not really a way for them to get disrupted, I think.
To be honest, I don't see we tend to like businesses with quote unquote optionality. where there's plenty of different ways they could monetize. I don't think Sprouts has a lot of optionality. That doesn't mean it can't be a great investment. You know, Walmart has been doing the same thing for so long. Like I don't, you know, and they've obviously grown over the time.
And the best thing about this, I think the best thing about Sprouts, and again, don't want to get too excited. It's not investment advice, but the bigger they get, the better the investment is, and the better the moat gets. Every year that they add more stores, it's a lot easier for them to defend their positioning. Right now, any sort of competitive advantage is more on a conceptual brand concept idea. But as they get bigger, it feels like the business solidifies, and that's why we do believe as they execute, there is room for multiple expansion. Now, the investment can do fine if they never trade a higher than 10 times earnings, but I would think if they solidify themselves as a dominant grocer in the United States, there's no reason they wouldn't trade at 20 to 25 times earnings unless we were in a huge, market drawdown.
And smaller store formats allows for cheaper operating leases, which allows them to build more stores, if that makes sense. So if you're spending less on operating leases per store, and let's say your threshold is, $1 billion in operating leases, if each store is less, you can have more stores in different places, which allows you to kind of go and get that geographic footprint faster. I don't know. So
there's a lot. I think there's a ton of stuff moving in Sprouts' favor from the business and the stocks perspective, and there's not a lot not. And that's why I think that sums up why we like it.
Right. And I think that's okay too. We try and ask ourselves the questions of what's the bear thesis, what can go wrong. And as long as you're thinking things through and asking yourself the tough questions, I think it's okay to really like a company. And just a couple of random points I wanted to throw out there that I put on my Mr. Money hat a little bit and what got nitty gritty with the investor call. There are two small things I picked up on that I actually think can be very valuable. One is they got rid of all of newspaper promotions, right? All the digital ads and coupons are either email-based, digital marketing-based. This makes me think of how they are putting a lot of focus on their target market, figuring out who their target customer is. That's one thing that I think is really valuable and really cool. Two is, I can't read my own handwriting, but I remember it. They changed their reward system for the employees to a hourly time worked system to a how much business did the store do. And I just love that small, simple change in perspective, that how can we reward our employees for a store doing really well? And that's something I found really cool.
Yeah, and that reminds me of another risk, and that is raising to a $15 minimum wage. That could be a definite, that's really the only macro, outside of whatever, an economic downturn that no one can control, but outside of that, the $15 minimum wage would impact them. They're now like Amazon or Costco, or I believe Walmart is too now, where they're getting into the $15 to $20 range. I think they said 80% are pretty close to $15 an hour, but
80%,
that would be,
that's the exact right number I was looking at.
Yeah, so it's that would be some expense headwind, but they have the room, they have the margins to deal with it. That would be a bit of a headwind in the short run, but they're gonna have to make that investment eventually.
They also spent a lot on bonuses this year for COVID and overtime, and I would not say this is a company that pisses off its employees. Like from what I've read, people seem happy working there. So.
I want to say 72% of their store managers were promoted from within. So you talk about them making investments in new stores. You also want to think about making investments in their employees and their people. So it's really important to think about as well, and a good sign that they're doing the right thing by their employees.
Yeah, and I guess another risk is Sinclair leaving. I think he really, everything he did wasn't super special, but aligning it kind of all together, it can work really well with changing the model, the store model, the distribution centers, the digital newsletters instead of paper stuff, changing the promotional things, making it so they're targeting the actual audience they want. All those things together were new from his management team. I mean, they were probably him and other people. If he leaves, which I don't think he would, that would probably be concerning to us. But there's no signs of that. So yeah.
Mr. Money, I get.
You can
Ryan,
call him
whatever.
Ryan. When you're talking, you can call him Ryan.
Okay. Yeah, you kind of mentioned this, but the whole idea of taking care of all your stakeholders, not just your shareholders, making the employees happy. Sometimes shareholders can overlook that, but when you think about it in a grocery store, like if you have a brand that resonates with customer loyalty, like if you have a lot of people that are constantly coming back to the store, you want happy employees. Like you want people that make the store feel like home for those loyal customers. And I think, paying them well is one way to do that.
Yeah, and Sprouts isn't Costco, but paying the employees well is one of the key reasons why Costco has done well, or the long-term at least. That's something I would argue. So Sprouts is not going to be paying their workers $22 an hour at any time soon, but if management cares, as investors, we embrace that.
As we start wrapping up the Sprout conversation, I have a couple more things I'd like to bring up, kind of Sprout related, but we all just go around and say one thing that really excites us about the Sprout thesis. I'll start off. For me, it is how low of a valuation it is, and the fundamentals are just screaming that this is a good value. Brett.
Okay, yeah, I'll go first. I was gonna say valuation because that's I think the most important thing here. But
I went first for a reason.
Yeah, you stole the easy one, but I think predictability, because unlike a concept company where you're just basing your investment thesis off hope, this is highly predictable. They can double their store count easily over the next decade. That's the most important thing to me.
Yeah. You want me to go next or
Ryan? Yeah.
Ryan? All right, I'll go. Kind of touching on Brett's point, the predictability, I would say capital allocation as well. They seem to be very efficient with it, whether it's new stores, distribution centers, reducing debt, share repurchases, everything just kind of points in the right direction.
Yeah, and kind of to your point, I think they're doing everything right on the financial side. So I won't steal that. So what I think is important to me, or what I like about it, excites me, is that they're marketing to a healthy enthusiast segment that is only going to grow in the U.S. I mean, you think about companies like Beyond Meat that have just done incredibly well and have seen a tremendous consumer reaction to their products. I think that's only going to grow. And as Sprouts tries to incorporate more options for people who are food diverse, I guess, I think only good things will happen.
Awesome. Yep. That was great. So one thing I wanted to point out to our cruisers, our followers, and also the Chit Chat Money guests, we at Cruising Altitude are really passionate about educating and inspiring the next generation of long-term investors. I've been listening closely to what Brett and Ryan have been saying. There were 3 takeaways that I think, for me personally, that is something that all good investors that want to become great investors can learn from. One is when Brett mentioned he signed up for the emails. When you are invested in a company, you can sign up for their emails. You can see how they are interacting with their consumers. I thought that was a fantastic point. 2, Ryan mentioned it, a little under the radar, but I picked up on it. It sounds like he's been to Sprout stores, correct?
Yeah, I think probably once or twice. Yeah.
Great. Awesome. So that's awesome too. When you can go to the store, go to the store. Oftentimes that a company says they're doing great, but then you go there and no one's there. And a lot of times the writing is kind of on the wall. And then 3, one thing that Ryan and Brett have kind of stressed the whole time is we're okay if this thing doesn't go up in the short term. Just the opposite. We like if it doesn't go up in the short term. It either gives them the ability to gain a bigger position in the company, or in this case, greater share buyback. So I think those are 3 fantastic points that anyone that's trying to become a better investor can learn from our guests, Brett and Ryan. Brett and Ryan, where can our cruisers find you guys on Twitter, social media? Because you guys are obviously very, very good.
Brett, go first.
Okay, yeah, we're on Twitter. Oh gosh, it's at Chit Chat Money. That is the one that's the big one that's to follow the podcast. We're on there as well, but you'll see in the bio for our handles. You can go to Arch Capital Investors. Oh no, archcapitalfund.com. I'm gonna get that right. That's correct, Ryan,
Yeah.
right?
Yeah,
Archcapitalfund.com would be where you can connect with us if you're someone that would look to invest. And then you can find Chit Chat Money on all your podcast platforms. And we do shows 3 times a week. So yeah, that's the best way to follow along with us. I would say if you really want to know how we invest, listen to the show.
Agreed. Yeah, everything Brett just said, I reiterate that.
Awesome. Mr. Money, any closing thoughts?
No, it was a pleasure having this conversation. Thank you guys for being on.
Yeah,
Thanks for having us.
Yeah, it was fun.
This was a blast, guys. Sprouts to the moon. Let's get it.